You need to know that the latest solution being pitched for America's housing squeeze could quietly transform your mortgage into something you never escape. What if the policy sold as a way to help more people buy homes is actually engineered so you may never fully own one? I'm Henry. I've spent years teaching people the real mechanics of money, and today we need to dig into a proposal with consequences that could reshape home ownership across the country. The idea on the table: mortgages stretched across 5 decades. And if you think that sounds like a sensible fix to make housing more affordable, you're about to see why this could be the most damaging financial trap ever invented. Before we unpack the ugly math behind the idea, consider something. When you picture retirement, what do you imagine? Maybe it's a time when work is optional, when monthly bills shrink, and you finally get to relax. For many Americans, a paid-off house has been a core part of that dream. But the policy I'm describing threatens to remove that cornerstone from the retirement picture entirely. Here's the situation. Today, the typical first-time buyer is around 40 years old. Pause on that. 40. People are now spending 2 decades in the workforce before they even buy their first home. Now, lawmakers are proposing a fix that could have those 40-year-old buyers still making mortgage payments into their 90s. Yes, into their 90s. At first glance, the pitch sounds tidy. Lower monthly payments, more people can afford a home. Problem solved. It makes for a great 30-second spot. But as with most things that sound too good to be true, the reality is uglier. Let me take you through the numbers because the arithmetic here is brutal. Suppose you buy a $400,000 home, a round figure that's representative of median prices in a number of markets. Use a 6% interest rate as our working assumption. With a conventional 30-year mortgage, the lifetime cost looks like this. Total payments across those 30 years end up around $863,000. That means roughly $463,000 in interest on top of the principal, which already feels like daylight robbery. Now switch the term to 50 years for the same $400,000 loan. Your total paid climbs to about $1.26 million. That's roughly $863,000 in interest. In other words, you more than double the interest bill just to shave a few $100s off each month. The monthly payment falls by only around $290. You sacrifice an extra $400,000 in lifetime interest to shave a few $100 each month. That's like trading away your descendants' inheritance for the price of a daily latte. To make this worse, think about compound interest, the financial principle Warren Buffett has described as the most powerful force in investing, either a friend or a foe depending on how it's used. With a 50-year mortgage, compound interest becomes your relentless enemy. Every extra year on the loan allows interest to accumulate in a way that devastates long-term wealth. Compound interest was built to make small investments snowball into large sums. Flip it around and it does the exact opposite. It turns your payments into a machine that enriches other parties at your expense. There's historical context here that should make Americans uneasy. Look back at Japan in the 1990s. The country faced a severe housing and asset bubble. Property values had soared until ordinary households couldn't afford purchases. One response was to introduce longer mortgage terms to lower monthly payments. The aftermath was catastrophic. When the bubble burst, real estate values collapsed by roughly 70%, and the economy spent decades trying to recover. For many people who were young when the crash happened, it wiped out decades of potential wealth accumulation, the so-called lost decades. That crash wasn't caused only by long loan terms, but stretching credit over longer horizons certainly amplified the damage and delayed recovery. Why does this matter psychologically? Because humans focus on small, recurring numbers more than they do the total cost. Behavioral economists call this payment bias. We instinctively fixate on the monthly amount owed, not the grand total. Car salespeople have exploited this for decades. They don't sell you the $40,000 vehicle. They sell you the $650 monthly payment. Suddenly, that car looks affordable because the number in your head is the monthly outflow, not the total debt. A 50-year mortgage preys on that cognitive blind spot. The monthly savings feel immediate and real, while the gargantuan long-term cost stays out of view. So people look at the $290 monthly relief and say, I can do that. What they are burying in their heads is the $400,000 plus in extra interest they will owe over their life. This is the financial equivalent of taking a predatory short-term loan from someone wearing a suit professionally trained to take advantage of your cognitive blind spots. You trade a short-term sigh of relief for a lifetime of higher costs. Underpinning this proposal is a real crisis. Home prices have run well ahead of wages for years. Mortgage rates after the era of near zero are now persistently in the 6 to 7% range, far higher than what many Americans became used to. Over the last decade, wages haven't kept up with inflation or housing prices. That's the problem policymakers should be solving. But a long-term mortgage term is an easy policy. It hides the affordability issue by stretching the burden in the distant future. It doesn't require building more homes, reforming zoning, or challenging entrenched local interests. It simply lets you borrow more for longer while the core supply shortage stays in place. The simple economic answer is obvious though politically difficult. Build more housing, increase supply, and prices fall. This is basic microeconomics. But building housing requires rewiring decades of zoning rules, land use policy, and NIMBY resistance. It demands political courage and technical work at local and state levels. Precisely the things that are hard. A 50-year option is the lazy fix. It looks like progress in press releases. It keeps existing homeowners content because demand, and thus prices, remains robust, and it enriches lenders. The easy path is always more tempting for politicians than the hard one that actually solves the problem. Beyond the headline math, there's another crucial dimension: equity. The chief reason people buy homes is to build equity, a physical asset that can generate generational wealth. That dynamic changes radically when you stretch amortization over 5 decades. With a standard 30-year loan, after a decade, you'll have paid down a noticeable share of principal. You start building real ownership. But with a 50-year loan, after 10 years, you've barely chipped away at the principal, often less than 4% reduction in the loan balance. After 10 years, you might sell and still owe almost what you started with. Most of your payments flowed to interest, not principal. You're not building wealth. You're paying rent to the lender under the guise of ownership. Think about retirement planning. Historically, the plan many American households assumed was to work decades. eliminate the mortgage by retirement, and then live on Social Security plus whatever savings were accumulated, a home with no mortgage payment was a linchpin of a workable retirement budget. Social Security averages around $2,000 a month for many recipients. A 50-year mortgage on our $400,000 example produces payments in the ballpark of that monthly benefit. In other words, Social Security alone will likely not cover housing for a retiree with a 50-year mortgage. When you hit retirement age and still have 20 to 30 years left on your mortgage, your options are bleak. Keep working into your 80s or 90s, sell and downsize but find you lack equity to make the move feasible, or rely on children to carry the burden.